prices in Saudi Arabia because they decide to a certain degree about the impact on the wider world. What do you see as the kind of latest OSPs trend in Saudi Arabia, especially the delivery out to the Asian markets? Do we expect the OSPs to continue their downward trend for the next month, or do we see a different picture emerging?
Thanks, Rohan. So the official selling prices to Asia come out once a month, and what we saw and really was very widely anticipated by the market was the emergence of the May OSPs earlier this month, because what we had was that OPEC Plus agreement, and then it was all eyes on what Saudi Arabia's next move. And ultimately, the cut that was implemented to Asia was greater than the traders expected. So the typical formula that traders look at in this market is the spread between the cash Dubai and the Dubai derivative spread. And that really just shows the relative strength, or ultimately in this scenario, weakness of the market. And that fell just over $3 a barrel month on month. But what we saw for the main export grades, and Arab Light in particular, which is really the flagship that everyone is looking at, fell $4.20. So while the market expected maybe a $1 to $3, there were some analysts that said actually they expected no cut to be implemented because of the OPEC Plus agreement, that maybe there would be a signal from Saudi Arabia that a tightening of the market was on the cards. But actually what we saw was that $4.20 cut to Arab Light. And that the market really interpreted as Saudi Arabia not willing to lose market share in Asia. Ultimately, right now, demand destruction is there, and the producers are looking to not lose customers as much as they can. So, one way you try not to lose customers is to be the cheapest one out there. And that's in turn really put pressure on other producers, because they are also then incentivized to cut their own OSPs as well to remain competitive. So it's a bit of a, not sure if it's fair to say race to the bottom, but you have to cut as much as your nearest rival to remain competitive. So the pressure has really been on producers in the Middle East, and also from further afield as well, because if you want to compete with long-haul crudes in this scenario, long-haul crudes, which the freight is going to cost more, there is a contango, so that can cover maybe some of it. But ultimately, you have to be competitive in this market. And what we've seen, going back to what we've just heard about WTI, admittedly, we haven't seen any negative territory for other grades, maybe Brent or the Dubais, but the pressure that has been put on WTI has now really rolled into the June contract. We can see that on WTI, and that in turn has been putting pressure on the international benchmarks. So with the question of do we expect the OSPs to continue their downtrend next month, certainly the market structure that was first mentioned, so that cut or that fall to the market structure that we saw in March actually has only increased through this month. So month to date in April, the spread really between cash Dubai and Dubai derivatives has fallen to average $9.70, and that's compared to minus that $3.11 in March. So that's a fall. So the market structure has ultimately fallen over $6 a barrel. So the market expects the Arab Light OSP to be cut further. And there's really questions around, will that happen? Will it be cut to by that $6? Because we've had 2 months of OSP cuts that have taken the prices $10 a barrel lower. And we're now in an environment of OPEC cuts. But then the question is, if Saudi Arabia do not cut, and then their competitors cut a little bit, then their competitors will be able to sort of undercut them. And also the price of transporting the fuel or the crude has risen as well. So you need those discounts to rise, greater discounts to counter that higher cost of transportation.